Start.
Hello, class. My name is Nestor Avila, and today we'll be talking about Wells Fargo, along with my group members, Jesus Barajas, Josue Cruz, and Chris Chiaramonte. All right, so here's the outline. I'll be talking about the history of Wells Fargo and 5-year total returns. So I'll be talking about the repurchase and dividend policy. Chris about the financial highlights, and Jesus about the long-term debt and effective tax rate. So Wells Fargo was founded on March 18th, 1852 by Henry Wells and Williams Fargo, which is where they got the name Wells Fargo, their last names. So they're in the industry of financial services, and some of the services they provide are banking, loans and credit, and wealth management. Their employees, the employee count is 258,700, and the president and CEO, which was chosen or elected in 2018, and his name is Charles W. Schwartz. All right, so here's a comparison of the 5-year cumulative total returns. So as you guys can see, Chase has had the edge for the past 5 years, including 2020 as well. Wells Fargo has been at a steady pace, small decline rate in 2019. So their net income in 2020, Chase has been doing, well, it seems like the virus has not affected them. They're doing better, way better than Wells Fargo. Wells Fargo had a negative second quarter, about $3 billion, which partly had to do with COVID. And other than that, they had bad investments. So they're currently at 0.652 billion compared to Chase 16.9. All right, now I'm going to pass it over to Josue for share repurchase.
All right, so for the share repurchases, back starting in March, banks had suspended buybacks and limits on dividend payouts due to the pandemic. They were preparing for in case it got worse, so eventually the Fed banned stock buybacks in June of 2020 for large banks with 100 billion in assets and over. So it was at the end, it was extended all the way to the end of the third quarter. And this was pretty much for preservation of capital in case the pandemic had worsened or was in trend to get worse, So before COVID, there was a trend in an increase in share repurchasing, and Wells Fargo had promised to return 31.4 billion to shareholders in 2019, and they had done that. And in 2020, they just it went down. So next slide. For the dividend policy, it was also capped by the Fed in 2020, June of 2020, and it was cut from 51 cents to 10 cents, which is an 80% decrease. And again, by pre-COVID, there was an increase in dividends being paid out, and pretty much dividends are paid out from the earnings. So it was earnings were doing good for. It was a trend, upwards trend, and as you can see on the graph on the bottom right, the dividend went down, and then analysts estimate that in the long run, it should work out for Wells Fargo. Moving it on to Chris.
Good evening, everyone. So I'm going to talk about the financial highlights of Wells Fargo, and we're going to compare it to its competitor, Chase. So as you can see, looking at the revenue generated from 2015 all the way to 2019, overall, Chase has been improving steadily, while Wells Fargo, the last 2 years, they've had a slight decrease in their overall revenue. Now, if we fast forward that to net income, we could see that from 2015, both Wells Fargo and Chase were very neck and neck. And since 2019, Chase has actually pulled higher net income over Wells Fargo's net income. And if we were to look at the overall profit margin, the profit margin from Wells Fargo has actually been decreasing, and this year's reported, or 2019's reported net profit margin has been 23%, where the profit margin from Chase is actually trending at 32% in 2019. Next slide, please. And we also conducted the DuPont analysis for these two companies. And as we could see as well, Wells Fargo had a higher return on equity in 2015. However, the roles have definitely reversed at the end of 2019, where Chase is actually has a higher return on equity overall. Next slide, please. As we could also see, and then the earnings per share price, Wells Fargo's share price has actually decreased from 2019 all the way to currently September 30th in 2020, where their share price actually decreased about 90%, where Chase's high point in 2019 has actually decreased about 30% and from September 30th, 2020 in their third quarter financial quarterly statement. Next slide. So as we can see from this year's stock price for Wells Fargo, they had a high at 51.67 starting at the beginning of the year. And when COVID hit, their stock price has significantly decreased, about 50% decline in their stock price. And they have just recently been improving. However, a good majority of their stock price that became stagnant is because they lost billions of dollars in the quarter two. And in the next slide, I'll go over JP Morgan Chase's stock price. So as we can see in JP Morgan stock price, the same thing occurred. They lost about 40 to 50% of their share price when COVID hit back in March. However, in November, December, overall, the share price has increased much higher than Wells Fargo's, which has in turn, getting close to the beginning of the high of 136.15 for the share price of JP Morgan Chase. And with that, I will pass it over to Mr. Jesus Barajas. Jesus, you're on mute.
All right, here we have Wells Fargo's long-term debt. We can see that it's been increasing from 2014. It peaked out at 2016. Since then, it's dropped down and averaged right around 232. So that's a good indication that the company's not having to leverage themselves, especially in this pandemic period where most companies are having to leverage and take on excess debt to survive the times. It looks like Wells Fargo just has enough cash reserves and they're able to do it on their own operational income without having to take out massive amounts of debt. So that's a benefit to Wells Fargo. Let's move on to the next slide. The effective tax rate, the cost of debt for them has been decreasing. So that's going to save them and in their bottom line, their net income. So that's another positive for them. And it started decreasing from the year 2016 to 2019. Let's go ahead and move on to the next slide. All right, so here we have a buy, hold, sell recommendation. We're actually recommending a sell based on the financial analysis that we just showed you. Chase is performing better than them. So, and the financials are undervalued, but it looks like Chase has already rebounded in their stock price more than Wells Fargo has. And that's an indication that Wall Street is also not liking the positioning of Wells Fargo at this time. So it probably bears more risk, and that's why their stock price hasn't rebounded so well. So based on these decisions and our graphs, we're recommending a sell. And with that, that's going to conclude our presentation. Thank you.